Hello and welcome to Need to Know, your weekly investment podcast brought to you by the experts at Coutts. I'm Sarah Muir and I'm joined as always by David Broomfield. Hi David, how are you?
Hello, I'm good, thank you.
Good. Now this week we're going to be talking about Europe with probably a bit of a focus on Germany, aren't we? Because obviously we've had elections recently, or this week. But before we get to that, quick fire numbers round. You go first.
Right, I'm going to go first. 50,000.
No idea. Is it like a currency or
Well,
it's just
okay,
a number?
let me help you narrow it down. Having said last week, this is an impossible task.
It is.
50,000 kilometres.
Oh, no, that doesn't help me.
Right, and I will relate it back to the topic we're talking about today in the most oblique, tangential way. 50,000 kilometres is the length of China's high-speed rail network, which is larger than all of the networks of high-speed rail in the rest of the world combined.
Wow, that's incredible.
And now let me shamelessly relate it back to our topic today. It coincides with some data which I was going to use this week that suggests that an intercity commute in Germany now takes longer and is less reliable than an intercity commute in the UK. And everyone who's listening to this on a train company in London and the southeast of England will now be shouting into the carriage that I'm wrong, but apparently that's true.
Yeah, not only is Deutsche Bahn less punctual than English trains, it's also less punctual than the worst, or British train operator, I should say. And as I say, I lived in Germany for around 14 years, and I got a lot of stick when I lived in Germany about how terrible everything was in Britain. So I cannot help but feel a little bit of schadenfreude at that news.
There we are. I mean, this comes back to one of the points that we're going to discuss today. I think that Germany needs to probably invest a lot more.
Yeah, exactly. Okay, well, my number is related very much to the topic this week, and it is 105 billion. Now, I'm going to give it to you in sterling, but that doesn't necessarily give you a clue.
Is this a number from the Draghi report?
No, it's not.
Okay, I don't know. Go on.
It's the amount that was put into or government spending on pensions in Germany in 2024. It's 1/3 of government spending was put into pensions in 2024. And they reckon that, I believe by, I think it's 2050, it's going to be, I need to check my numbers now, something like, that number's expected to double by the time they get to 2050, because it's an aging population. It's another one of the topics we've talked about quite a lot, demographics, and it's a big problem in Germany.
Yeah, well, it's a big problem all across the rest of the Western world. I think in Germany, it's about 42% of gross income people pay in social security contributions. So it's very high in the OECD, extremely high. I mean, you said, projections are this is only going up.
Yeah, exactly. So we're not just talking about Germany, are we? We're talking about Europe as a whole. So how are we going to break that down? And obviously Germany is going to be one piece of that jigsaw puzzle.
Well, yeah, I mean, Germany, I think we'll keep it focused on Germany because of the elections. And I think before we get going, though, let's talk about what's happened in European equity markets and perhaps what's driven that performance, certainly year to date. And then we can get into some of the German headwinds and what does Europe's largest economy face in the years to come. I think that would be quite interesting. And we can contrast, the German experience with that of Spain and Poland, which both of which are absolutely motoring ahead. And then I think the third topic will be how sustainable is this current performance? So we've seen this equity market rally. Let's talk about then the future. Let's get the crystal ball out and see what we think about earnings and what we think about the future.
Yeah. Okay, great. Well, let's kick off then with this sort of great start to the year for European equities. Last time I looked, the Stoxx Europe 600 was up about 8.4% year to date, which is outperforming the US. Why?
Yeah, I mean, it's been a fantastic start to the year for European equities, and lots of people are saying, I told you so. I mean, remember the backdrop here. I always think step back from short-term market performance and periodicity and start looking at just the structure of capital markets on both sides of the Atlantic, okay? In Europe, you just have so many smaller global companies compared to the US, which just dominates global market capitalization, okay? what's been driving European performance this year? And for those that aren't aware, the stock 600 is up around just under 9%, about 8.8% at time of recording. That's way ahead of where the S&P is, which is up only around sort of 2%. And you've seen the big global asset managers, the big banks come out and re-rate European stocks. They're saying that fundamentals are improving. I think the reality here is that you've just seen such a disconnect in valuation that the market is effectively repriced. Okay, you've got two things happening simultaneously. You've got the markets cautious but not panicked about the US situation, pricing in some risk premium around US political volatility. And meanwhile, in Europe, you've had extreme valuation disconnects. European companies are materially undervalued compared to their global equivalent.
And how much of that also is the fact that obviously the US was dealt a bit of a shock with the announcement of DeepSeek, sort of cheaper, less resource hungry AI model, whereas obviously that didn't impact European stocks quite so much. Is there a little bit of that as well?
What, in the sense that they're being more resilient?
Yeah.
Well, the European story, I think, is all about tariffs. So like context here, European equities are around 37.5% at discount to the equivalent sort of US stocks. Okay, so they've just been, a lot of what you've seen this year is just that valuation gap closing. That's a very technical argument. That's just people saying things are too cheap. They're overstretched, they're dislocated, and therefore I'll be a contrarian. When you look at actually what's been driving the market, you can separate. I think this is really interesting. If you separate out European corporates into those that have kind of outperformed or underperformed, you see that the ones that have outperformed are quite predictable. The European defense stocks rallying on increased military spending, and they're those stocks that are less exposed to tariffs. So you've got this kind of bifurcation happening where you have companies that are kind of European firms that make stuff in the US and have US sales and production. They've really outperformed, and then flip it on its head. Those companies very exposed to potential EU tariffs have actually underperformed.
Yeah, you talked about European stocks being undervalued. There was a recent Bank of America survey, wasn't there, that looked at, where it talked to 200 European fund managers. 38% of respondents think European stocks are undervalued, with a net 12% fund managers are overweight European stocks. And if we compare that to December, when the survey was last carried out, there was a net 25% were underweight European stocks. So is it a lot of it then is about price? It's cheap. It's not cheap for a good reason. So now is the time to start looking at Europe.
Yeah, look, there are other narratives that sort of underpin this. I'm not going to say shift in sentiment, but certainly there's been renewed interest this year. You've had lower energy prices. I mean, I've said for a couple of years now that Europe is very much at the behest of the weather when it comes to how expensive winters get, and the inflation print due to their couple of decades dependency on Russian gas coming to an end. So you've had lower energy prices compared to that 2022 peak. You've had anticipation of ECB rate cuts to support growth. Now, this is a tricky one because, the reason the ECB cuts rates is because growth weakens, but nevertheless, it's potentially a tailwind for equities just on that discount rate. Then you've got this optimism over the peace dividend, over potential geopolitical easing in Ukraine. So that explains some of those sort of sectoral moves, particularly defense stocks and even green tech to an extent. So there are other narratives that it's not just it's cheap. I think people are saying that it's cheap within that context. I think for me, it comes down then to, well, how sustainable are the earnings, and how exposed are EU companies to the US situation? And remember, we've got half of world GDP between the US and the EU. And this is what I think is fascinating. Like, if you believe Trump's rhetoric that he wants to do deals and sort of follow the money, so to speak, then he would. These are the kind of deals he would want to. He would want to do deals with one of his largest trading partners, certainly the EU's largest trading partner. And, if you just follow the money, you think, well, this must be rhetoric from the US, because what the situation with sanctions in Iran showed is that when you released in sanctions from Iran, America just didn't start miraculously trading with Iran. In fact, trade never recovered. If you release sanctions from Russia, I don't think it's going to herald a new era of Russia-US trade. And I think when you look at how trade flows are structured around the world and where the concentration of sort of raw GDP might is, it's not between the US and Russia. So this is why I think a lot of this is about negotiation, and I think Europe actually is holding quite a few cards when it comes to the transatlantic situation. So I think its current performance reflects a combination of valuation advantages, sectoral strength, and this slight optimism over policy. On the other side, you've got tariff risks. I think that's rhetoric, because if you just look at the raw size of EU-US trade and EU-US GDP, I can't see how it isn't just rhetoric. I might be wrong. But I think that's the headwinds for Europe this year. It's that uncertainty. It's that just predictability of unpredictability.
Okay, and we're going to come back in our final point to how sustainable this is. So let's turn now to Germany. They had their election on the Sunday before we recorded this, and so I guess not a huge surprise that the CDU were the largest party. Now, we're not going to get into the politics here, but I guess it's talking about Germany is the engine of Europe from a point of view of the economy. It's the largest economy in Europe. It's very important in that respect. So what are the headwinds that Germany is facing as they move forward? And obviously at the moment, they're still negotiating the coalition. We don't know exactly how that's going to form and what will be agreed for that coalition to sort of take place. But what are they, and we've already talked about the aging population with my quickfire number, but what are the challenges then that Germany faces if they're going to restore the vigour to their economy, which frankly they haven't seen for the last 2 years because they've had negative growth?
Yeah, exactly. Negative GDP growth for 2 years. It's the sick man of Europe, as I think you alluded to when we when we did the Draghi report. I mean, this economic contraction and sentiment has been pronounced, and I posted a chart just this afternoon on LinkedIn, just showing the the economic sentiment indices that are published by the European Economic Research Centre of European Economic Research, and it shows that optimism in Germany is pretty much absent when it comes to business optimism. So if you consider that a forward-looking indicator, which everyone in the market does, it reflects market sentiment being a real headwind for Germany. So what that index does is it surveys 9,000 German companies across manufacturing, construction, services, trade, and basically then forward projects 6 months business conditions. And it's anemic, to say the best. They've been in a downward trend since 2018. You had a slight bit of optimism when after COVID, but then Russia invasion of Ukraine just was a double blow, and the sentiment is really, really fragile. So you've got just general business sentiment being anemic. Draghi talks about this a lot in his report, about this fact that we just need to invest a lot more in Germany. And Germany's implicit, Europe. And it's about perhaps relaxing the fiscal rules that Germany has governed itself by for so long. Because, it's very, we use the rail example as a quickfire number, but it's symptomatic of a broader issue that there's been chronic underinvestment, chronic under government investment in Germany for some years.
Yeah, so essentially for that to happen, Germany is going to have to abandon the debt brake, isn't it? Which has been at the heart of their fiscal policy for as long as I can remember.
Yeah, without abandoning that, I mean, it's difficult if you go back to your sort of national accounting and your sort of sources of GDP growth. Without increased government expenditure and increased debt, it's difficult to see how Germany won't grow beyond its estimated potential. And that estimated potential, if you go and look at all the investment bank research and the big sort of think tank research, is somewhere between 0.3% and 0.4% annualized through to the end of the decade. So there needs to be, and this is what Draghi talked about, there needs to be this marked change, profound change in how the public sector manages investment.
Yeah, because I think, as you're saying, the debt brake currently limits budget deficits to 0.35% of GDP. And German states, because obviously Germany's a federal country, so you have these individual federal states, each must have a balanced budget with zero new borrowing. Now, that's going to have to change as well, isn't it?
That will have to change. I mean, but debt-filled growth is just one part of it. And borrowing to invest and borrowing to generate GDP growth is absolutely absolutely fine. That is really what the debt markets are about. They're not about just financing expenditure today. They're about investment. And the reason I say that's only part of it is the other part of it is just Germany suffers from really high production costs, slow and a lot of bureaucracy. You've got this really slow permitting process, which hinders investments in things like infrastructure. So as an example, it takes about 120 days in Germany to attain a business license. That's more than double the OECD average. And contrast that with, say, the UK or the US or countries that score very highly in that respect, where it takes literally a matter of days. So you've got the debt brake, you've got general bureaucracy. I think there is a potential, when I looked at the numbers, certainly when it comes to debt, to probably unlock somewhere in the region of about 50 billion euro annually in extra spending without breaching the EU rules. But the point is, you've got to have the political will to do that. And you've still got gridlock over this thorny issue. So I think you need proposed reforms. You need the tax cuts. You've got to overhaul pensions. I mean, you touched on demographics. I don't think we can labour this point enough, right? I mean, by the end of the decade, 2029, you're going to have 5.2 million additional Germans reaching retirement age, but only 3.1 million entering the workforce. Yeah. So, okay, we've all got this problem, but Germany needs to probably overhaul its very generous pension and retirement policies as well. So I think you need fiscal overhaul, changes to debt brake policy, and crucially a more kind of pro business agenda that resolves some of these sort of permitting issues and these slightly bureaucratic issues that I've highlighted.
And recognizing that there is a shift in the type of economy that Germany is. Because another statistic I was looking at is that since the pandemic, there have been 250,000 manufacturing jobs lost. Now, unemployment hasn't gone up because those jobs have shifted to services and telecoms and things like that. And if you look at the three biggest, car maker, steel, chemical companies in Germany, so Volkswagen, ThyssenKrupp, and BASF, over the past 5 years, they've lost something like 50 billion euros in market capitalization.
Yeah, I mean, they're just struggling to compete with other regions of the world. Yeah,
I was going to say energy costs are a big factor, aren't they?
Energy costs are. I mean, much of the German sort of industrial complex has been built off imports of very cheap Russian gas. And either gas as a feedstock to other processes, or gas just simply to underwrite factors of production, and that's over. And the EU is one big tariff block and works almost cohesively to block other countries from dumping cheaper goods into its market. But Germany is struggling with a national identity. I mean, I've talked about industrial policy a lot on the pod, a topic which 2 decades ago would have been a way of sort of stopping a conversation at a dinner party, suggesting that government should adopt some kind of industrial policy. But I think what we're realizing now is there's political appetite for it. There certainly is political appetite for it in the US. It's well established in China. It's happened in Korea. It's happened in Taiwan. And I think now Europe is slowly coming to this idea that Germany in 20 years' time isn't going to be making cars. Or if it is going to be making cars, it's not going to be making the kind of cars it is today. It'll be a much smaller niche industry.
Yeah. So in theory, I mean, we've painted a slightly bleak picture of the German economy, but in principle, there's nothing to stop them other than the political will to sort of and finding that consensus in the government. There's nothing to stop them. They've got the tools in their toolbox essentially to turn this around.
They do, and I think that sort of leads us into the outlook and our third topic. I mean, Germany, which we've talked about a lot today, is the economic engine of Europe. So if you turn Germany around, you would turbocharge Europe. And I think that if you think of investors right now favoring sectors that are less exposed perhaps to the US situation and those that might benefit from EU fiscal support. So the obvious example today is defense. I think we've seen announcements even in the UK today that all countries in Europe and the UK need to increase defense expenditure. Now, we talked in the Draghi report, one point that was highlighted by him, that the majority of EU defense contracts actually go to the US.
Yeah.
So back to my point again about the gravity of trade and the size of the EU and the US. Like, okay, I'm sure there are a lot of defense contractors in the US that don't relish the idea of trade tensions rising. But in any event, there's a good that Europe has a lot of very high tech defense companies that stand to benefit. But there are other stories as well. As I said, there are European companies that manufacture in the US. And I think there's a good story there. But it's about, I think, Southern Europe right now driving economic growth in Europe. Okay, I mean, we've talked a little bit about this previously, about Italy, about Spain, and about Poland. Very dynamic, fast-growing economies. If Germany can be fixed, quote unquote, then you've got quite a dynamic force, I think, in the world.
Yeah, and obviously, I guess a lot is dependent on what happens in the geopolitical landscape. I mean, let's see what happens with Russia, Ukraine. But I suppose there's nothing to stop Europe having its own policy, its own relationship with China, and just not being allied to the US necessarily. I mean, they can have. I mean, I know that the Spanish Prime Minister has met with Xi Jinping on a number of occasions, and Ursula von der Leyen has called for efforts to improve relationships with Beijing. So they could, I guess, if things do get more problematic with the US, they could just go direct to China and have establish a stronger relationship with China.
Possibly. I mean, this it was always a very benign, if not positive, relationship for a couple of decades, and recently, obviously, it's turned negative. There is a lot of pressure being applied by the US to Europe to limit access for Chinese companies to things like UV lithography. So these very, very complex, Dutch-made machines that print microchips. There's very, very strong lobbying to make sure that those machines aren't housed in China. So I think Europe is always going to find itself between these two markets. I don't think it's a case of picking sides. I think they have to engage with both of them. The US is the largest trading partner, and China, a principal trading partner, not quite as dependent as it was a decade ago, but is still extremely important market for European exports. So I think really for me, the European outlook comes down to sort of corporate earnings. And if you look at projections where we are today, they're projected to grow over this year, European corporate earnings by around sort of 7.98%. Now, that's healthy, but it's trailing where the US is forecasted, which is somewhere between 14 and 15%. So I think for me, it's about diversification. So Europe, remember, we've got this valuation disconnect, which has sort of been the source of the rally this year. If you think of surprises to the upside, ECB sort of stimulus, perhaps some fiscal stimulus from Germany, you wouldn't need much, I think, to move the market from here. And I think that's the positive note, that although, yes, earnings growth is trailing the US, I think everyone is acutely aware of how concentrated they are currently in 7 stocks in the US and how dependent they are on continual earnings surprises, positive surprises from these companies to generate outperformance. So Europe, I'm not going to say by default could benefit. I think that's too critical. But I think people are looking currently at diversification regionally with some interest and seeing some really good companies in the US that can potentially be less immune to tariffs.
Yeah, you mean some companies in Europe?
Oh, in the EU,
less immune
sorry.
to tariffs.
Yes, in the EU. Apologies.
So we're not sort of dismissing the current sort of rally in European stocks. There are reasons behind that, and we're saying that there are some challenges. Germany being the one, because it's the biggest economy in Europe, and that's the one that needs to, certainly they're going to need to unleash a little bit of spending, a little bit more public spending. They're going to have to loosen those fiscal rules. There's got to be a lot of investment there. And you mentioned also the importance of the trading relationship between the US and Europe, and that's something that we wouldn't expect to be dismissed or thrown away out of hand. So we would expect that to continue. So I guess the outlook then for European stocks is it's not an either or. It's part of diversification as far as regional exposure is concerned. And there are some interesting areas there. So you mentioned Spain and Poland in particular as the countries that are really driving growth in Europe at the moment. So, and a lot will depend on what happens with Germany when they get their new government in place and the decisions that they make. And it could be quite exciting.
Yeah, I mean, look, Germany's just huge. So we have to pay attention to what happens in Germany. And I would start looking at those companies that have global diversified revenue streams that aren't just so bilaterally dependent on one particular market. And there's lots of those in Europe. Okay, everyone's familiar, obviously, the big pharmaceutical firms, but there are others as well. And I think it's often overlooked. But we are in a period where geopolitical risks are high, and there's lots of sources for volatility out there. So as always, it's about diversification, not just picking one region over the other. It's about, I think, looking for a sensible exposure to all global regions.
Yeah, okay. On that note, a reminder that the views expressed in this podcast are not intended to constitute investment advice, are accurate at the time of recording, and are subject to change. Thank you, David. Thank you for listening. Until next time on Need to Know, bye for now.